Let's talk Chevron, downgraded to underweight. You don't see that often. That's at JPMorgan. The firm saying its valuation looks increasingly full. It's our call of the day. Jason Snipe, you own it. What do you think about this?
Yeah. So obviously Chevron has had a tremendous year, up 45% year to date. I mean, it's really played into the supply-demand story early part of this year. I mean, energy period is up 40%. You know, and they've really done a great job with cost containment, capital discipline. You know, so for me, I haven't trimmed it yet. You know, with some volatility in the energy space, I could see that happening in the next couple of weeks for us, you know, as a firm and looking to trim it. But it's got the best balance sheet in the industry. So for us, you know, it's been a market weight hold for us, you know, here. So I still like it. We'll see what happens over the next couple of weeks.
All right. So, Steph, it's your largest position, at least it was. I know you've been trimming some energy holdings. So what do you do now? Yeah. Right. The stock's had a great run. 6 months, it's up 80%. Year to date, near 50. Is the valuation now just too rich?
It's had a nice run. First and foremost, this analyst had a neutral on it all the way up. So to go from a neutral to sell, he missed it, right? So I get it, though. It's up 45%, but it still yields a 3.3% yield. It's a juggernaut, Scott. It's a powerhouse. It's Chevron and Exxon, and then you barbell it with all these other things like the Schlumbergers and the Diamondback Energies that I own. But it's a juggernaut because they have steady production. They're lowering their capex, and as a result, they have a huge free cash flow, and they're putting it to work. They increased their buyback to $10 billion from $5 billion. And they also increase their dividend. So I like it. I'm going to hold on to it. I might shed the other names, but this one I'm going to keep.
Jim, you've been trimming energy. Do you feel like this trade is about done?
I feel it's going to take a temporary pause. I mean, remember the things that I was saying about supply likely to come online, and if oil just slightly goes below 100 down to 95, I think that's going to take a lot of sentiment out of the sector. You've got to recognize that Chevron is a quarter of the XLE. I'm still overweight energy, but I would look to add to energy on pullbacks, which I think will be coming, and when that happens, Chevron's likely one I will add. It's the creme de la creme in the group, but I have been trimming. I'm sitting with what I've got right now. I would look to add on pullbacks.
John, what do you do with the calls you have?
Well, Scott, as you know, because you and I have talked about it now for 6 weeks, I had a lot of stock. I've exited almost all of the stocks in the energy space, but my exposure is the same. I just replaced stock with options, with call options and call spreads. What do I do with these calls? Like Jim said, on dips, I would buy them. I mean, look at Steph's point is excellent here. This particular analyst had a very dim outlook for this stock and was dead wrong. Why am I going to follow this analyst now? If there was a reaction to the downside on it, I'd be happy to buy more calls. But this isn't even denting the stock today, Scott. I think all energy goes up for basically the next 3 to 6 months across the board. Uranium, BTU like Peabody and Patterson Energy, as well as all these oil and gas stocks, because the cutbacks and the sanctions, that's going to be the result, higher energy prices.
Yeah, no, I think people are afraid to sell these stocks for all of the reasons that you just said, John. Anastasia, this trade, done? More to go. What do you think?
I don't think it's done. I wouldn't be exiting the energy space right now. If you look at the price of crude where it is today, it is actually around fair value. I mean, we're still looking at demand that's rebounding strongly, and supply is a big question mark. So at this level of prices, I think we can, first of all, expect them to be sustained. And at this level of prices, oil and gas companies in the U.S. are making a lot of money, which, by the way, if we're trying to ramp up production and we have $100 barrel of crude oil, this is the time to do it. So we should say have high prices, higher production. This all bodes well for energy shares. And Scott, I'll just say that amidst this tough market environment, you want to be adding dividend payers to the portfolio. And like Steph said, energy offers a very nice dividend yield and probably one of the better trades to hedge geopolitical risk. So I'm sticking with it.
I mean, Farmer Jim is right, though, Anastasia, right? I mean, one positive, I can't think of a sector that has more headline risk to it than energy. If you get a wholly positive bunch of headlines from Ukraine, this trade is going to look in trouble, at least for the time being, potentially.
Well, I would tell you that oil would probably look in trouble. You could have some pretty big gyrations there, but I would still decouple, oil from the energy shares themselves. If you have anywhere above $40 or $50 a barrel of crude oil, which we have well above that, that is a very big margin of safety. That is a very big profit margins for some of these companies. So yes, maybe you take a little bit of gains, maybe you pull back a little bit, but in this environment where we can't have this certainty to know which way this breaks, I would rather hold a cash flowing asset that's increasingly high quality. The leverage is quite low in the energy space, that produces a dividend, and it gives me that risk that if we're not right and there's no de-escalation in Ukraine, that this is one of the better hedges still.